here, Miriam Gonzalez with the Family Realty team. Today, we're going to talk about how inflation has impacted mortgage rates. When you read about the housing market, you'll probably come across some information about inflation or recent decisions made by the Federal Reserve, the Fed. But how does those two things impact you and your home buying plans? Here's what you need to know. The federal funds rate hikes have stalled. One of the Fed's primary goals is to lower inflation. And in order to do that, they started raising the federal funds rate to slow down the economy. Even though this doesn't directly dictate what happens with the mortgage rates, it does have an impact. Looking at this graph, inflation has recently started to cool, a signal those increases work and are bringing inflation back down. As a result, the Fed's hikes have gotten smaller and less frequent. In fact, there hasn't been any increases since July. And not only has the Fed decided not to raise the federal fund rate the last 3 times the committee met, they've signaled they may actually be rate cuts coming in 2024. According to the New York Times, Federal Reserve officials left interest rates unchanged in their final policy decision of 2023 and forecast that they will cut borrowing costs 3 times in the coming year, a sign that the central bank is shifting towards the next phase in its fight against rapid inflation. This indicates the Fed thinks the economy and inflation are improving. Why does that matter to you and your plans to buy a home? It could end up leading to lower mortgage rates and improved affordability. Mortgage rates are coming down. Mortgage rates are influenced by a wide variety of factors, and inflation and the Fed's actions, or as has been the case recently, inaction, play a big role. Now that the Fed has paused the increases, it looks more likely mortgage rates will continue their downward trend as shown in this graph. Although mortgage rates may remain volatile, their recent trend combined with expert forecasts indicate they could continue to go down in 2024. That would improve affordability for buyers and make it easier for sellers to move since they won't feel as locked in to their current rate, the rate that is very low. In conclusion, the Fed's decisions have an indirect impact on mortgage rates. By not raising the federal funds rate, mortgage rates are likely to continue declining. Let's connect so you can have good advice about changes in the housing market and how they affect you. Thank you for watching. This is Miriam Gonzalez with the Family Realty team. Have a wonderful day.